Well, as a critical infrastructure for the financial services industry, DTCC has been at the forefront of the FinTech evolution in the last couple of years. Just a couple of examples of that. DTCC was a founding member of the Hyperledger project, exploring different blockchain technologies. We're also in the process of replatforming our trade information warehouse as it relates to credit default swap transactions. And also we've made an investment in a company called Digital Asset Holdings, which is very active in blockchain technology. So given that DTCC is at the forefront and very supportive of FinTech technology, we felt that it was important at the same time to develop a risk framework along the same path that monitors these risks as they evolve and potentially the benefits associated with FinTech. So we felt it was important to get a paper out there now in the early days of the FinTech evolution, before some of these technologies really take hold, to ensure that, as I said, both DTCC and others in the industry develop appropriate risk controls before the risks advance too far and it might be too late and systemic risks might evolve. So one of the key factors we're looking at is the extent to which interconnectedness develops. Now, interconnectedness can be a double-edged sword, meaning that FinTech can help diversify service providers and reduce concentration risk in the industry. But the potential flip side to that is when you have many more entrants and firms providing services in the industry, you've now created a much wider web and network of players in the sector, which increases the potential for a single point of failure. And also, given a lot of these firms are startups by nature, the extent to which they have time-tested operational and cyber controls is still uncertain. So their interconnectedness is something that needs to be watched carefully. Closely related to that is the issue of substitutability risk, meaning that if a service is deemed critical by the financial services sector, if there really is no substitutable service to replace that, should that service or service provider go away, that could create an impact on financial stability. So substitutability is a very critical factor as well. Third, I would say that the extent to which regulations and policies develop in line with the FinTech evolution is going to be critical. We need to make sure, and the regulators need to make sure, that there's a framework in place globally to ensure that risks as they develop are monitored by the regulators and appropriate frameworks are put in place. Another concern around that, or issue, is the extent to which regulators cooperate globally, because there's always a risk of regulatory fragmentation and arbitrage that could happen globally, especially when you have a FinTech evolution that's global in nature and so many different firms and aspects to it. And the last thing I'd mention is probably concentration risk. Is FinTech can have a positive impact on concentration risk by the fact of new entrants coming into the market and maybe taking some services away from traditional banking entities. But again, the flip side to that is, are these firms really time-tested in terms of being involved in these markets and having operational controls and cyber risk controls? So those are some of the issues that we cover in the paper. There's several others. And again, these, I want to be clear that we're not saying in any way that FinTech is a risk today. We're saying it's early days, these need to be monitored and understood to determine over time, are the impacts of FinTech could be positive, could be neutral, or they could create new risks. So, for example, I think I mentioned a little bit earlier the possibility of the network expanding of players in the industry. So I think, for example, cyber risk, I think it will be important to ensure, and this is both from a regulatory standpoint and from the industry policing itself, that these new entrants have appropriate cyber controls and that they meet industry standard cyber protocols. The NIST framework is one that's very common. So whatever it might be, we're just ensuring that firms meet market standard best practices. It's going to be critical. So given it is early days, we're really just hoping to create a dialogue, and so the paper hopefully is a springboard to further discussion with industry players, regulators, and anyone really involved in this evolution. And it's to raise awareness on some of these potential risks and make sure that firms are thinking about what they should do now before we go too far down the path of some of these technologies, as I mentioned earlier, and develop appropriate frameworks to assess these risks as they develop.